Welcome to the Times of Industry show, and I have with me today Charles Ortel, and he's an investor and a writer. Look, he's interested in economics, geopolitics, history, travel, and just plain lasting peace. He's a proud father of two great young adults, and the reason I have him on is because he's by far one of the most knowledgeable people in the business. Now, let me just explain to you, this is not just an economist. This guy has retired at 46. He's now 61, and he knows what he's talking about. Charles, how are you today?
I'm very fine. Thanks for having me on.
I am very, very excited to have you on, actually. I want to get started. Look, you've done it in private equity. You've done it in the hedge fund business. You are a Harvard graduate. You've done it all. You came from academics. You went into Wall Street. You made a lot of money for a lot of people, including yourself. And you took the way out. And we'll get to that because you realized that the markets were rigged, faked, manipulated in 2001. And that's quite incredible. I want to start with something that's going on right now. Ray Dalio, the world's largest hedge fund ever, Bridgewater Associates, which he founded. He just appeared in front of the Federal Reserve Board and other top-ranking bankers. We're talking just a few weeks ago, and basically presented the case that central banks are out of time, out of options, and out of tools. He said to them that first, what you did to resolve this debt cycle that we're coming to the end of is lower interest rates to zero in hopes to stimulate more borrowing. And then you started QE to stimulate the economy again. Now, both of these had short-term effects on the marketplace, and now it's all but gone. And what he proposed, or basically what he told him, is I forecast that the next step is that you'll start injecting liquidity straight to the consumer, basically bypassing the financial sector and the banking system. What's your take on this sort of prediction? He said this is not helicopter money yet, but he said that in this type of fiat monetary system where debt cycles cannot really be extinguished like they should be under a gold standard, because you basically you move the debt from the people who have the debt have to pay for this. In this sort of economy, they can do all kinds of manipulations, and the debtors will end up just hyperinflating their debts. What's your take on this? Because this guy is obviously one of the best investors of all times. You probably know his work and have followed it. Is this the next step here?
That's a great question. So I'm somebody who said that, and has said for some time, that the global system actually entered purgatory around December 31st, 2008. We're neither in heaven nor in hell yet. We're in purgatory. And ever since then, what happened first was that our U.S. Central Bank, the Federal Reserve, pushed interest rates way below where they should be on a unadjusted for inflation basis. Virtually to zero, while at the same time, the incoming Obama administration, with the support of Congress and both parties, decided that reckless government spending should be the order of the day, whether it was accounted for properly or not. So we've been doing that ever since January of 2009. And that's a long period of time in the trading cycle. I come out of investment banking and private equity and long lead time projects, 2, 3, 4, 5-year projects. But traders, you're an active trader, 8 years into the game. I mean, you've done a lot of stuff and you're getting tired of it. So a lot of the trading community, the human-based trading community, has little experience with the world in which I grew up, where you have a risk-free rate that was a tough rate. The 10-year, if you use that as a benchmark, U.S. Treasury rate in the period, let's say the super high interest rate period, but say 82 to 99. That average, I want to say from memory, is 7% or so on the 10-year. And now we're well underneath 3%. We're like 230, 240. And the way we would look at things way back then was, I know I can get a certain safe rate of return over 10 years, how much more should I be compensated for taking either a public equity risk or even worse, a private illiquid equity risk? And, rough rules of thumb, we'd say, 2.5 times the benchmark rate is what we want to make a liquid equity investment, and maybe 3.5, 4 times for private equity. Those days are out the window. The history that the younger people have, they just don't know what it's like when things revert the way I feel they're going to revert. So what we've done, Dalio is absolutely right. We've escalated the total amount of debt on the global system, on the U.S. Economy and on the global system to levels never seen before. And then you have to, I'm even bleaker, I think, than Dalio, because what you have to do is you have to divide the world roughly into the part of the world like the United States, Western Europe, Israel, certain economies in Japan, certain economies in Asia, where wages are relatively high on world scale. And then you think about the what's happening in technology. It's not simply that they're gee whiz robots or better software. It's that the geometric, thundering advances of technology have changed the ways in which we do business to the point where all a mammoth percentage of jobs in these rich economies are under threat and are certain, I think, to be suffer wage pressure and or even elimination. So we've got way too much debt, we've got dwindling incomes, and GDP. A lot of people get comfortable saying, "Well, my debt on a country as a percentage of GDP isn't that bad." Well, GDP is a cooked number. If you go back to the person who created it, it was popularized or it became used actively in the United States in 1936 or thereabouts. The brilliant economist named, I think, Kuznets, is, some say, the father of it. And even he, in the letter that he wrote to the Senate Finance Committee explaining the work that he'd done and laying it all out, he points out the double counting, the flaws in it. And when you boil it all down, I think a far simpler measure to look at than GDP is just simply private incomes, private sector wages and proprietors' incomes, pre and post tax. That's what people, normal human beings listening to this broadcast, unless they're very rich, and I say even if they are very rich, try to live within the means of their wage and proprietor's income, right? You don't really, if you're going to get a rate of return on your capital, you've got to reinvest your dividends and your interest in order to get the targeted rate of return. You shouldn't be using that to live. So you're living off your wages, your proprietor's income, and tax rates vary, but in the United States they're extremely high when you consider all the variables. So we have a towering debt, and we have wages that are under threat both by taxes and by technology. And that's the negative picture. And what's the positive picture? The positive picture is, as bad as it is in the United States, it's worse in many, many economies around the world. So I like to say that the United States is the least dirty shirt in the laundromat. And when people elsewhere are thinking about what happens if the United States falters, because if we do falter, the rest of the world will certainly catch a cold. People are going to say, well, yeah, the U.S. has got problems, but as a store of value, I'd rather keep my money in a U.S. bank or in a U.S. asset than in a troubled European bank. And we can talk about the European system that's so deeply troubled and blowing up. Or in Asia, where transparency is virtually non-existent. So I think we're going through a period here where the globalists, it sounded great, globalism, back in 1989, 92, when, the United States was the superpower in the world. But the truth, I think, will be seen in history that we decided we could all be globalists, but we didn't have the infrastructure to check globalism, to make sure that the reports were truthful. And there is no effective regulation of globalism. So we haven't derived as society the benefits of these, in theory, great superstructures that will make everything better. It just hasn't worked out that way. Instead, we've gotten bureaucracies. And around the world, to be a smart investor today, you have to know, you can't be as it was back when I started in 1980. You could just say, well, I don't care what's going on in India. It's a tiny place compared to the U.S. economy. Let's just focus on the U.S. You can't do that anymore. And for years, you haven't been able to do that. And when you look around the world, the theory that Europe will blow up, but you're going to make your money on growth in India and China and Brazil and Russia, I think that's smoking some serious cannabis.
That's very interesting, Charles. You bring up the point that the markets are synchronized, and I've talked about this often, that the fact that all markets are moving together. It's like one giant machine where if somebody moves higher, everything moves higher. If somebody moves lower, then all of them moves lower, and that's a very dangerous market to be in. The United States is now, with Donald Trump as president, starting to, along with other nations, protect their borders, trying to domesticate the economy and not rely on globalism. In fact, the global trade has been subsiding for 2 years now, decreasing. And every time global trade as a whole has shrunk, that has led to a recession in the United States. Since World War II, the global trade has declined 13 times, and 13 times we've seen a recession the year after this. Are we heading into another recession in the United States?
From the traditional definition of 2 consecutive quarters of GDP decline, you could well see what some might call a recession. But I think there's a major opportunity here for the Trump administration, whether he'll go through with it or not, to change the tax system, to defang the wasteful part of the regulatory state while empowering the pieces of the regulatory state in the SEC and the FDA, elsewhere, that have been improperly, in my view, defanged, while encouraging American companies to repatriate capital and foreign companies to move into the United States. I mean, if you think about it, speaking as somebody who has invested all over the place, it's a pain to invest in structures outside the United States, via islands and these small countries or whatever, where the rules can change. And imagine how life would be so much better if the United States, instead of being anti-American investor, said we are in fact going to lower the corporate income tax rate, to a far lower level. It's competitive on world scale. We're going to do everything that Ireland has been doing to attract investment into Ireland. We're going to do, but we're going to take it a step further. And then suddenly, the tax haven strategies, other strategies, you have a flood of capital coming into the United States of America, which, after all, is different than Europe. We are not as densely populated as Europe. We do have a massive infrastructure. Some say it's crumbling. You don't see evidence of that in the Northeast, et cetera. You don't see dire straits. I mean, certain places you do, but as a general rule, our infrastructure is competitive compared to the rest of the world, and it's a big, deep market in the United States that has a large amount of capital and checkable deposits and things like that. So our banks have the ability to be sounder than any European bank, because there is no European country remotely as big as ours. Yet their banks, through mergers, have gotten to be these lofty structures that rely on brokered deposits, so they're not that safe. Even the banks, I would argue, in Switzerland and elsewhere, they're just simply not that safe, especially if you're going into kind of crisis we could be in. Obviously, the Japanese banks are not safe. Clearly, the Chinese banks are not safe. So when you start looking at it that way, you could say, on the one hand, yes, you could see GDP decline, but offsetting that, you could see a flood of capital coming in here and the kind of structural change happening that I think we need around the world. The structures, the big bureaucracies in government have not yet been disrupted the way they have been and will continue to be in the private sector. So America is it's a place filled with dynamism. Now, what are the risks? I mean, we have obviously the risks of potentially another 9/11 style attack. We have, it's summer coming. We could have riots again. We have the the intense animosity between the right and the left, or those who favor, let's say, both parties and those who are against the uniparty. We do have issues, but from a purely economic standpoint and investor standpoint, I think the United States will weather the problems that are on the horizon far better than medium-sized countries such as, let's say, to pick on one, Belgium, or some of these countries in Europe, I think are in serious trouble.
Now, do you think this trouble has to do with demographics? Europe is very aged, and the type of socialism, type of entitlements they are offering the retirees starts at a very early age. The type of socialism that they offer is much broader than the United States. For instance, in France, if you have a back pain and you're 50 and you worked at the post office, you're retiring at 45, and they will pay your taxi to your chiropractor, and they will pay for your chiropractor as part of your pension plan from 45. How can a country sustain that? Do you think that the United States, with 80 million people right now retiring, with the entitlements that they've been promised, something has to give? The amount of unfunded liabilities cannot be met by taxes in the United States, especially if you're going to cut taxes. So how do you see this equation playing out? I wonder, how risky can the United States political system get if a quarter of the country starts realizing that what they've been promised since early age is going to be either cut or delayed, or something, someone will tell them that entitlements are not laws?
Right. Well, that's another good point. Or another good set of questions. So one of the areas that I do spend a lot of time thinking about is this whole issue of how demography affects the health or the sickness of an economy. And when it's very interesting, frankly, to look at long time series data on the U.S., which exists and is pretty good, at least it's pretty consistent, going back to really 1900 or before by year. And what you see in the beginning in the United States is data very similar to what you now see in Africa and in some of the poorest countries in the world. And even in 1900, we were well along, decades into industrialization, but we still had a situation back then where the youth segment of the population was the biggest segment, and where the second biggest segment was people, I would argue, 25 to 54, and the smallest segment was 55 and up. We had a blip in 1918, I think, was the only year where the population went down because of the Spanish flu. And then we had the Depression, and people made decisions in the Depression to have fewer children. So all of that played out over long periods of time. And then we had World War II end, 1945, the baby boom. So we had an extremely unusual period in the United States of America in 1982 to 1999, which is really, as you rightly pointed in the open, it just happens to have been a dream period. Why was that unusual? Because people in the age category 25 to 54 increased at higher, ever-increasing percentage gains in that year. So a flood of new people entered that age cohort, while the number in the senior cohort didn't increase that much. So it was a very unusual period. People aged 25 to 54, generally speaking, broad generalization, tend to make the most contributions to economic activity as measured by GDP. They form households, they buy houses, they furnish houses, they have children, they spend more money, and it was a robust period. Well, compare that to what's happened since 1999. We've had all the problems, and as you rightly point out, we're in a place now in the United States where the baby boomers have been retiring. They're increasing as a share of the total population, but in no way are we as in bad shape as the worst country for that on earth is Japan. Inside Europe, a country that's in desperate shape is Italy, judging by the statistics, which may or may not be correct, that they have very high level of senior people, a dwindling number of people aged 25 to 54, and they're not having kids. So, what's the growth prospect of a country that's like that? Not so good. So, yes, I'm not trying to say America's great, nobody else, and, we don't have our problems, but compared to Europe and certainly compared to Japan, the demography issue is not a huge issue, relatively speaking.
Okay, well, but let's dig deeper here. Not relatively speaking, the unfunded liabilities, how will they be funded? What do you see as a viable plan here?
Okay, so it depends, what we mean by the liabilities. I mean, there's a simple, in my mind, there's a relatively simple trade to be had by politicians who find their courage, and they may only find it as they stare over the cliff. But in the United States, as you know, there's a cap. Your income reaches a certain level, and you contribute no more to Social Security. And I could envision a trade where either you push the cap way up or you eliminate the cap in exchange for other tinkering in the tax code. So if you wanted to address the situation with regard to Social Security, which I think is one of the more pressing issues, you could do it that way. As far as healthcare, which I think is the biggest drag on an aging population, particularly in our country, our politicians couldn't get their acts together last week. They're, for excellent reasons, because the tort bar lobby is so strong. We're not doing what we need to do to change the way in which people take risks when they get health care. The amount of money that is spent by patients and doctors trying to avoid getting sued, the amount of money that's spent on malpractice insurance, we have to address that. We have a situation that's out of control. We have to address a delivery structure for medicine and for health, which seems to involve getting people hooked up to expensive pills. I mean, you take a step back and you say, how many pills? My own father is 90, and he's been on a pill regimen for a while, and I see what happens to him. I think there's some structural issues in the way in which we deliver and finance healthcare that could be dealt with. I mean, I really do think we should be able to buy and sell insurance across state lines. That's not healthcare, but that does affect the provision of healthcare. If people buy insurance, then they'll go to a doctor and maybe they'll have a better shot at being healthy longer. There are there are a number of different structural changes. Then I think the other one, and this is not a popular position of mine, but it's one I feel strongly about. I understand in the private sector why a poorly managed company could find itself in a position where it had a union. Because you could imagine bad managers make stupid decisions, workers get upset, they try to leverage to gain some power against the bad manager, a union results. I do not understand the need for public sector unions. I don't get that now. I get it, maybe 60 years ago. But right now, when you look across the American economy at the excellent data that's on the Bureau of Economic Analysis website, NIPA tables, you can see that unlike in the private sector, as compensation levels rise, businesses find a way to replace expensive workers with other means. In government, there's no such, data shows no such trend. So, and so it seems to me that the time has come. You mentioned those pensions. The time has come to say, listen, you government workers, you got it pretty good here. I mean, these days, there aren't any pensions in the private sector. Government workers do get pensions. Some get them after 20 years of service. It's time, as I say, for some readjustment there. And you don't have to do it draconianly. In other words, tomorrow morning, take away everybody's pension. Just say, this is the way it's going to work going forward here. After all, the employers of all these government workers are we the people. So why do we the people need to be protected from we the people? It just doesn't make any sense.
Interesting, Charles. How do you view a gold position at this particular point? Do you personally own gold or silver?
Well, yeah. So without getting into great depth, every family has a bias and some things they like and things they don't like. And our family, first, in recent history, first got involved in 1849, finding gold in California, and later 1864 in Montana. So just for nostalgia reasons, you can fight about it. It takes a lot of time and energy to go examine General Electric's financial statements and figure out whether it's over or undervalued. It doesn't take that much time to figure out whether you really do have a lump of gold, and if so, whether it's being offered to you at the market price or not, and whether you find the market price attractive or unattractive. So yeah, I like gold and silver. I even like platinum, which generally, when the industrialized economy was heating up, platinum would be more expensive than gold per ounce. Now it's less by a lot. And I think I'm not giving investment advice over the phone, but if you just ask me, my personal view is I think that gold should be part of someone's portfolio who is managing money for the long term.
Sure, as a form of savings, as opposed to just having fiat currencies.
Right. But or put differently, when we look around the world, can you point to one government that has behaved responsibly with regard to economics for more than, say, 5 years?
Sure. No, I totally understand that. And I want to ask you this, from an investment point of view, the S&P 500 is now trading at its most expensive valuation since the dot-com bubble, and then you've got the Great Depression, obviously, as the second time in history where stocks have been this expensive. Obviously, this is part of the fact that we've been living on zero interest rates for so long, and that there's so much liquidity from the QEs into the financial sector. Now that they're starting to raise rates, and I don't believe they can raise rates meaningfully, but they can trickle this in. Will this affect, like you said, where you're trying to figure out, should I take a bond or should I buy a stock and take on more risks? Do you think stock valuations are going down? Do you see this as something that's beneficial to the market and for investors? And do you think this can get volatile? Do you think this will be a more quiet revaluation of stocks?
Well, I think we're headed for a period that's going to be more extreme than the August-September 2008 timeframe, because at least in the period leading up to August-September 2008, I want to say, depending on what recent period you look at, that in the 2001 forward period, I think the 10-year might have averaged through, say, September 2008 around 5%, roughly. We have a very different recent trading level on the 10-year, or the interest rate level on the 10-year. And in the past, when there has been a correction, a tough correction, in 10-year rates have moved, severely higher than 5%. So, most people are worried about whether they might go to 3% or 4%, but if you had a true crisis of confidence, if you had a failure, you wake up tomorrow morning and a Citibank is out of business or something like that, you could see pandemonium. Now, going to the trading level of S&P 500 or S&P 400, whichever one you want to pick, I like to look, company by company. I'm old-fashioned in that way. And what you're really seeing now, and have seen for months and years, is the strange scenario where the yield that you're going to get on a multinational company, the dividend yield, will be a significant percentage of the 10-year yield. And what that's effectively telling you is that the market doesn't see much potential in the stock. And then when you take a harder look at, and you can do this off of publicly available information, you can look at the consolidated financial results, and you look through the footnotes, and you can look and see where are they booking, what is the trend in revenues inside the U.S. and outside the U.S. They typically give you those figures. And then what's the recorded pre-tax margin inside the U.S. and outside the U.S. And then you can do some work, and you can guesstimate, the capital expenditures and try to come up with a free cash flow ratio to revenues. And I just think you look at a company like Boeing, and everyone says Boeing's a great company. I think it's a horrible company. You look at the cash flow margins are minuscule. The leverage that governments, U.S. and other, have over the company are huge, and unions against it. And it's trading on very thin margins. And you'd be shocked when you look at do this kind of work and compare, what are the cash flow margins of these businesses today in 2017 to their predecessors years ago? And, they're just, many of them are horrible, horrible businesses who have kept their prices up by buying back shares. So when you look at the balance sheet, you see shrunken equity, sometimes even negative tangible equity. That's to say, in a liquidation, you'd get nothing. So yeah, those who are cautious now are very wise people.
Charles, lastly, Donald Trump, worst approval rating probably from any president in the last 40, 50 years. It just dropped to 36%. The average is 63%. If I was the president, I would be saying to myself, I have 4 years going forward. I will not get reelected if this is my approval rating. I need to do something to prove that I am worthy of this. What do you think is the pressure on the president right now? And what do you think we will be seeing by the summer, as the United States government right now spends $4,000 per second and has a treasury of $200 billion, which will be empty by around June 1st. And they will need to tackle this debt ceiling all over again. What do you see going forward in 2017 for the United States government, and how will this affect the economy?
Okay. So I'm not, though I comment on politics and I have my views, I'll confess, I didn't vote in 2008 for either McCain or Obama. I didn't like either one of them. And I didn't vote in 2016, in part because I was leading this effort to expose matters at the Clinton Foundation. And I just didn't want anybody to say, that my analysis of the Clinton Foundation was colored by my political views. But in Donald Trump, I think you have an unusual human being who, was written off even before he started thinking about running. And then as he ran, he was written off by the Republicans and had that work out for Jeb Bush and 15 or 16 other people. And then he was written off by the Clinton camp and the Democrats and had that work out for Hillary Clinton. So, he had a rough Friday. And yes, he can be vulgar, and he can, maybe he shouldn't tweet quite so much, at least tweet on the subjects that he's tweeting on. But here's a guy, the one thing I've never met him, but I observe is that he doesn't have to work, yet he works, 24/7, relentlessly, and I think productively. He listens. He's not an ideologue. He's a practical person. I like to say that, he's a builder, not a bungler. And a lot of the people in Washington, D.C., and Republicans, Democrats, unaligned, are bunglers. They get involved in the swamp, and all they want to do is live off the swamp. So if you're asking me what are some quick wins, I don't understand why he went for Obamacare first. I would have gone for tax reform first. That's where he's going to go next. Tax reform to me is very simple. On my site, actually, I have, I think 2 years ago, I laid out a 10-point plan that involves, one of the points has something to do with tax simplification. The reason that the swamp has so much power is the tax system's so complicated. If you went to one simple approach, scored it dynamically, because people who have wealth will change their behavior if you lower tax rates, as we saw under Kennedy, as we saw under Reagan. So forget the static analysis of change. Assume some kind of dynamism in behavior, and I think lowering tax rates would do a lot. It's something you do quickly, and especially also if you simplify things. I also think that Donald Trump is sincere when he said that the Democratic Party has done little to nothing in the inner cities inside this country, which have been in the main under the control of the Democratic machines. And, I think there's a lot of good real estate, good, well-located real estate, particularly in the Northeast, but elsewhere throughout the United States, that is now derelict, following decades of machine oppression, frankly. And while we are in debt, we could borrow some more money, and I think some sensible I hate the public-private partnerships in general, but sensible thinking about how to go into these blighted inner cities to attract businesses that should be back in the center, close to their customers, lessening logistics costs, maybe making mixed-use projects, and there's a lot of stuff that could be done that would bring capital back to this country, would bring jobs into populated areas where people are frankly out of work. But we need structural change to accompany it, and we can't try the same old business as usual pork belly politics. So, I think inside the country, tax reform and that are two great things. Obamacare is already blowing up. To fix it, you need structural reform there too. And that's a lot to do, just those three things. Forgetting about what we might want to do to reinvigorate our military, be more sensible about how we prosecute our activities outside this country. And I don't think Donald Trump cares what the mainstream media has to say. I mean, in this country, the United States, I believe over 90% of all the journalists gave money either to Bernie or to Hillary, and they don't. I mean, Donald Trump could announce that every American's going to get a check for $10 million, or let's say gold worth $10 million, and the mainstream media would complain about it.
Yeah. Charles, listen, we are going to have you on for a sequel interview, and I'd love for you to share some of your experiences in the stock market and kind of how you value companies, how do you research companies, etc. And I'd also like to get your intake on the marijuana legalization process in America. What do you think of that globally? And some many other topics. So I'm very glad to have you on today, and thank you very much for the interview, and we will definitely touch base again and have you on.
Thanks so much. It's my pleasure.
Charles Ortel is now 61 years old, but he's basically retired from the age of 46. This shows you the potential power of two interesting themes. First of all, being a capable man and having the tool set to create fortunes in the marketplace, and secondly, having the greatest bull market of all times, the 1980 to 2000 bull market at your back. I've created a model portfolio for 2017 where I break down all of my investment themes for this year, and that includes a thorough outlook of this year at wealthresearchgroup.com/2017. Charles Ortel is an expert on the Clinton Foundation and just how corrupt and illegal their actions are. He suggests owning gold, and with regards to safe havens, we created a report that includes a combination of the ultimate safe havens at wealthresearchgroup.com/safe havens, and we just released an exclusive one on Bitcoin and a new cryptocurrencies under the radar and completely unaware. For 99% of investors don't even know this cryptocurrency now exists at wealthresearchgroup.com/Bitcoin. It's phenomenal. Just go ahead, download it, learn about this new cryptocurrency and see whether or not this is something that you want to take part of. Lastly, Charles spoke of the need to prepare for retirement. With zero interest rates in most developed nations, we released an exclusive report on how to gain 8% yields on your stocks with a rock-solid business model used by a very unique niche of companies. In fact, it's one of the largest companies of its kind in the US, and that's on wealthresearchgroup.com/cash flow. I'd like to thank you for tuning in week after week, gaining more and more knowledge, becoming more savvy, and increasing your financial fortress, which is the most important thing you can do. And join us through the month of April as we dive back into the gold sector now that it's been beaten down and it's ready to surge higher with the summer politics turmoil that we're going to experience in the US.